Hi there, and welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Absolutely. It's great to have you here.
So, we've been hearing a lot about midterm rentals lately, right? The whole trend of 30 to 90-day stays is really picking up steam.
Yeah, it's fascinating, isn't it? It opens up a whole new avenue for real estate investors, especially for those of us looking for flexible income options.
Exactly. And today, we're diving into that. We'll explore why midterm rentals are becoming so popular, how they can fit into your investment strategy, and what you need to know to get started.
We'll also touch on some practical tips for managing these properties effectively, and maybe even share a few success stories.
Oh, I can't wait. It's all about making real estate work for you, right?
For sure. And we'll break down the benefits and challenges so you can make informed decisions.
Perfect. So let's jump right into it and start with what makes midterm rentals so appealing for investors today.
You know, Sarah, the trend towards midterm rentals, those 30 to 90-day stays, is really gaining traction, and it's especially relevant for folks over 40 right now.
Absolutely, Mike. With so many people considering their retirement plans, this could be a game changer.
Exactly. You've got retirees or near retirees looking for ways to supplement their income. Midterm rentals can provide a steady cash flow that's often more reliable than traditional long-term rentals.
Right, and it's not just about the financial aspect. There's something comforting about having that steady income coming in, especially as you're thinking about retirement and wanting to feel secure.
Definitely. And let's not forget inflation. With costs rising, having a diverse income stream can really help protect your finances. Midterm rentals can often command higher rates than long-term leases, which helps keep pace with inflation.
That's a great point. I've spoken with several investors who've transitioned to midterm rentals, and they've noticed that they can adjust their pricing more dynamically, reflecting market conditions.
Yes! And I had a client, let's call him Tom, who was in his late 50s nearing retirement. He switched to midterm rentals in a college town, and he found that his properties were often booked solid during semester breaks.
So he was capitalizing on the demand from traveling professionals and families visiting their kids at college, right?
Exactly. Tom told me that the extra income not only supplemented his retirement savings, but also gave him peace of mind. He felt like he was in control of his financial future.
That sense of control is so important, especially with the uncertainty in the economy these days. It can be emotionally taxing, thinking about how to provide for yourself and your family in retirement.
You're spot on, Sarah. And we're also seeing a shift in how families are thinking about property. There's this desire to create a legacy, to pass on wealth to the next generation. Midterm rentals can be a smart way to build that wealth over time.
Right, and I think about how many people want to leave something meaningful for their kids. Instead of just handing over a lump sum, they could provide them with income-generating assets that can appreciate over time.
Yes, and I've seen families come together to manage properties. They'll pool resources to buy a multifamily home, for example, and then operate it as midterm rentals.
That's such a smart strategy. It fosters teamwork and communication within families. I imagine it also helps everyone stay connected.
Absolutely, and they can share the responsibilities, like managing bookings or maintenance. It's a great way to bond while also building wealth together.
That's really inspiring. And let's not overlook the current economic trends. Many people are hesitant to buy homes right now due to rising interest rates. Midterm rentals can provide an alternative way to invest in real estate without the commitment of a long-term lease.
Exactly. It's a way to dip your toes into the real estate market without overextending yourself. And, the flexibility is appealing.
Yeah, and speaking of flexibility, I've heard stories of people who travel, but they still want to maintain their home base. They can use their properties for midterm rentals while they're away, generating income instead of leaving them vacant.
That's a great use of existing assets. I had another client. Let's say her name is Lisa. She started traveling for work and decided to turn her home into a midterm rental while she was away.
And how did that go for her?
Well, she was able to cover her mortgage and then some, which was a huge relief. She felt like she was living her dream while also ensuring her financial obligations were met.
That's really impressive. So it's not just about making money. It's about creating a lifestyle that supports your goals.
Exactly. And it's also about having options. As people get closer to retirement, they want to know that they can afford to travel, enjoy life, and still have a safety net.
And with midterm rentals, they can achieve that balance. Plus, it allows for more personal interaction with guests, unlike traditional long-term rentals.
Yes, that personal touch can make a big difference. Many investors have mentioned how rewarding it is to meet people from different walks of life, which adds a layer of fulfillment to the investment journey.
It's like being part of a community, even if it's transient. And for those over 40, it's about creating experiences and memories, not just financial gains.
Exactly. And let's not forget the potential for capital appreciation. Real estate generally appreciates over time, and midterm rentals can help you hold on to that asset longer while generating income.
So it's a win-win situation. You're building wealth while maintaining flexibility and creating experiences.
Right. And now that we've talked about why midterm rentals are so important, let's dive into some core strategies for making this approach work effectively. So let's dive into some of the core strategies and rules of thumb that can really help when you're looking at midterm rentals, right?
Absolutely. I think starting with a simple rule like the 1% rule can be really useful. It's a quick way to gauge if a property is worth considering.
Exactly. So the 1% rule essentially says that your monthly rent should be at least 1% of the purchase price. So if you buy a property for, let's say, $200,000, you'd want to aim for at least $2,000 in monthly rent.
Right, and that gives you a quick snapshot of whether the investment could be viable, but of course, that's just the first step, isn't it?
Yes, definitely. After that, you'd want to look more closely at your expenses. Enter the 50% rule, which is a great guideline for estimating your operating expenses.
Oh, I love the 50% rule. So if you're bringing in $2,000 a month from rent, you should plan on about $1,000 going toward expenses, right?
Exactly. That covers things like maintenance, property management fees, property taxes, and insurance. It's a good way to keep your cash flow realistic.
And then there are things like capital expenditures too, right? You want to make sure you set aside some funds for big ticket items like a new roof or HVAC system.
Absolutely. It's crucial to have that buffer. Now, moving on to the cap rate, which is another key metric.
Right, the cap rate is a measure of the property's profitability. You calculate it by dividing the net operating income by the property's purchase price.
So if you're making $12,000 a year in net operating income on a $200,000 property, your cap rate would be 6%.
Which is pretty solid, I'd say. A cap rate gives you a way to compare potential investments.
Exactly, and when you're looking at different properties, a higher cap rate generally indicates a better return on your investment. But be cautious. Sometimes a high cap rate can mean higher risk too.
That's a great point. So it's all about balance, right?
Yes, and part of that balance comes from understanding the property type you're investing in. For midterm rentals, you might be looking at different types of properties than you would for traditional long-term rentals.
Right, like single-family homes or small multifamily units could work really well for midterm rentals, especially in markets where there's demand from traveling nurses or professionals on temporary assignments.
Exactly, and speaking of markets, evaluating the right market is crucial. You want to look for areas with a strong demand for short to midterm housing.
So things like proximity to hospitals, universities, or major employers can really make a difference, right?
Yes! And also consider seasonal trends. Some markets might have a peak season, so understanding when that is can help you maximize your rental income.
And then there's the importance of doing your homework on local regulations. Some cities have specific rules about short-term rentals that could affect your plans.
Right, you want to know if you need permits or if there are restrictions on how long you can rent a property. It's vital to keep everything above board.
So let's talk about deal evaluation checklists. What's your go-to for that?
Well, I usually break it down into key categories: location, property condition, financials, and potential for appreciation.
That makes sense. For location, I'd make sure to look at things like crime rates, schools, and amenities.
Exactly. And for property condition, you want to assess how much work is needed before you can start renting it out.
And don't forget about the financials. I always recommend running the numbers, like calculating cash flow and return on investment.
Right. I'd also include a sensitivity analysis. What happens if your rent is lower than expected or if expenses are higher?
That's smart. It's all about being prepared for different scenarios.
And then, when it comes to financing options, you have a few routes, don't you?
Yeah, traditional mortgages, private lenders, or even using equity from existing properties to finance new ones can all be options.
And let's not overlook the power of partnerships. Sometimes teaming up with someone can help you leverage more resources and knowledge.
Absolutely. It's like building a stronger foundation for your investment journey.
Now, as we transition into common pitfalls, it's critical to recognize that midterm rentals can seem attractive, but there are some traps to avoid.
Yes, like underestimating the costs involved or not fully understanding your target market.
Exactly. And sometimes investors might focus too much on potential cash flow without accounting for the time and effort needed to manage these properties effectively.
That's a big one. Balancing time investment with financial returns is key to ensuring your venture is sustainable in the long term.
So let's discuss those pitfalls in detail next. So, one of the biggest pitfalls I see with midterm rentals is over-leveraging.
Right, that's a classic mistake. Investors can get excited and go all in, thinking, I'll just take out a bigger mortgage or use all my savings.
Exactly. And then what happens? They suddenly find themselves stretched too thin, struggling to cover the mortgage if they have a month or two without tenants.
Yeah, I imagine that must feel pretty overwhelming. How do you think someone can avoid that?
Well, first off, it's essential to have a solid financial buffer. I always recommend having at least 3 to 6 months of expenses saved up, just in case.
That makes sense. It's like having a safety net, right?
Exactly. And then there's the issue of bad tenants. It's something most investors don't think about until it's too late.
Oh, tell me about it. What kind of stories have you heard?
I remember one case where an investor was so eager to fill their property that they skipped over the screening process for tenants.
Oh no. What happened?
Well, they ended up with a tenant who, let's just say they weren't the best at paying on time. The investor thought they could handle it, but after a few months of late rent, it just spiraled into a mess.
That's tough. So what advice would you give to someone to help avoid that situation?
It's really about taking the time to thoroughly screen tenants, checking references, running credit checks, the whole 9 yards. It might feel tedious, but it's worth it in the long run.
Absolutely. And I suppose ignoring cash flow is another common mistake, right?
Yes! Cash flow is king in real estate. I had a client who was really excited about a property in a trendy area. They thought, it'll always be rented, but they didn't do their homework on the expenses.
So what did they miss?
Things like property management fees, maintenance costs, and even utilities can add up quickly. They ended up with negative cash flow, and it was a real eye-opener for them.
Ouch. So how can someone keep track of those expenses?
I always suggest keeping a detailed spreadsheet or using property management software. It helps you see where your money's going and spot any potential issues early on.
That's a great tip, and I know timing the market can be tricky too.
For sure. I mean, the idea of buying low and selling high is great in theory, but it's really hard to predict.
Right. Sometimes the market just doesn't cooperate.
Exactly. I had an investor who waited for what they thought was the perfect moment to buy, but the market kept going up, and they ended up missing out on a lot of great opportunities.
That must have been really frustrating for them.
It was. The key is to focus more on the fundamentals of the property rather than trying to time the market. If it makes sense for your long-term goals, then that's what matters.
And what about hidden costs? I feel like those can really sneak up on you.
Oh, they definitely can. I've seen investors who didn't account for things like HOA fees, insurance, or even property taxes that suddenly increased.
Yikes. Those can really eat into profits if you're not prepared.
Exactly. So I always recommend doing a thorough cost analysis before purchasing. Look at every possible expense and then some. It's better to be safe than sorry.
So true. What are some red flags you would say people should look for early on in the process?
Well, if a property has a history of frequent tenant turnover, that's a big red flag. It could indicate underlying issues either with the property itself or the neighborhood.
That's a good point. And I suppose if the owner is in a hurry to sell, that can also be telling.
Definitely. If they're pushing for a quick sale, it's worth investigating why. there could be something they're not disclosing.
That's kind of concerning.
Yeah, and if you notice properties in an area that are consistently sitting on the market, that could indicate a declining neighborhood.
Right, you don't want to invest in an area that's losing appeal.
Exactly. And, it's always wise to listen to your gut. If something feels off, trust that feeling and dig deeper.
Great advice. So if someone finds themselves in one of these situations, what can they do to recover or avoid future pitfalls?
Well, first, it's important to reassess your strategy. Look at what went wrong and learn from it. Don't be afraid to ask for help, whether it's from a mentor or a real estate advisor.
That's so true. Learning from mistakes is part of the journey, right?
Absolutely. And remember, it's a marathon, not a sprint. Real estate investing is about long-term wealth, so focus on building a solid foundation.
A solid foundation is key, and staying informed helps too.
Yes, continuous education is essential. Attend workshops, read books, listen to podcasts, like this one, to keep yourself updated.
And network with other investors. Sharing experiences can really help you avoid those common pitfalls.
Definitely. Surrounding yourself with like-minded individuals makes a huge difference. It's all about building a supportive community.
Well, I think that wraps up a really insightful discussion on midterm rentals and the common pitfalls investors face.
Yeah, it's been great chatting about this. There's always more to learn, and I hope our listeners feel empowered to take the next steps in their investing journey. So to take that leap into midterm rentals, you really want to start with some actionable steps.
Absolutely. What's the first thing someone should do?
Well, I'd say start by researching your local market. You can use apps like Zillow or Realtor.com to get a sense of rental prices and demand.
Right, and those sites are super user-friendly. You can easily filter by area, price range, and even property type.
Exactly. And then I'd recommend looking into the local MLS if you have access. It often has more detailed data than general sites.
Yeah, that's a great tip. And while you're at it, check out tools like Rentometer to see how your potential rental compares to the market.
Yeah, Rentometer is fantastic for that. It gives you a good overview of rental rates in your area, helps you stay competitive.
And once you've got a grasp on the numbers, you might want to dive into some financial analysis tools.
Right, tools like the Bigger Pockets Calculator or Deal Check can help you crunch the numbers on potential deals. They're pretty intuitive too.
Oh, definitely. And if you're new to analyzing deals, you could set a goal to evaluate just one deal per week. It's manageable and really helps build your skills.
That's a great habit to get into. You get more comfortable with the numbers and the process.
Plus, it keeps you engaged. And while you're at it, consider joining a local real estate meetup or online group. Networking can be so valuable.
Absolutely. Connecting with others can lead to partnerships and opportunities you might not find on your own.
And don't forget about educating yourself. There are some fantastic books and podcasts out there.
For sure. The book on rental property investing by Brandon Turner is a solid read.
Oh, I love that one. It's packed with practical advice. And podcasts like Bigger Pockets Podcast are great for hearing from experienced investors.
Yeah, listening to other people's experiences can really open your eyes. It helps you learn from both their successes and mistakes.
Exactly. And if you're thinking about specific strategies for midterm rentals, the Real Estate Guy Show has some good episodes on that niche.
That's a good call. It's important to stay informed and adapt to changes in the market.
And let's not forget about the importance of setting clear goals. What do you want to achieve with your investments?
That's crucial. Maybe you want to replace your income, save for retirement, or build a legacy for your family.
Yeah, and writing those goals down can make them feel more concrete.
Definitely. And start small, You don't have to jump into a big investment right away.
Right. Even if it's just one property that you can manage well, it's a step in the right direction.
Exactly. And as you gain more experience, you can scale up from there.
So, to recap, start with research, utilize tools for analysis, connect with others, educate yourself, and set those goals.
And don't hesitate to take that first step, no matter how small it may seem.
With those tools in your pocket, you're ready to move forward. Let's recap what we've covered today.
All right. So as we wrap up today's discussion on midterm rentals and that whole 30 to 90 day stay trend, I think we've really highlighted some key points.
Absolutely. First off, We talked about how this model can provide more stability compared to short-term rentals, right? It's like you're kind of balancing the flexibility of traditional rentals with some of the perks of vacation rentals.
Exactly. And then there's the fact that these midterm rentals can often attract a more reliable tenant base, like traveling professionals or contract workers, which can be a real game changer for your cash flow.
Yeah, and let's not forget about the potential for less wear and tear on your property. Fewer turnovers mean less maintenance hassle, which is a big plus when you're looking to build long-term wealth.
Right, and we also touched on the importance of doing your research on local markets. You really want to know where the demand for these rentals is strong, so you can position yourself effectively.
And, of course, staying compliant with local regulations is crucial. You don't want to invest time and money only to run into legal issues later on.
Definitely, Sarah. It's all about setting yourself up for success. So, to anyone listening, remember that building wealth through real estate is a journey. It takes patience and a bit of strategy, but it's absolutely achievable.
Yes, and if you found today's episode helpful, we'd love for you to like, subscribe, and maybe even drop a comment about your biggest takeaway or any questions you might have.
And don't forget to share this episode with someone over 40 who's looking to invest in property. You know, we're all about building a community here.
Next time, we'll dive into something really exciting. Furnished Finder for travel nurses. It's a fantastic resource that could open up more opportunities for your investments.
Can't wait for that discussion. It's going to be super informative.
All right, thanks for joining us today. We appreciate you. And happy investing.
Take care, everyone.